Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Bill Bymel. He has been a real estate investor and broker for over 20 years and is currently the CEO of First Lien Capital, a distressed mortgage platform he founded in 2021. They focus on resolving a subperforming and non-performing mortgage loans on residential and commercial real estate and have purchased over 1,000 residential mortgages and REOs in 30 plus states since their inception. So Bill, thank you so much for being on the show today.
Charles, it's a pleasure to be with you. Thanks for having me.
Yeah, no problem. So you've been in real estate for decades now. Can you tell us a little bit about yourself, both personally and professionally, prior to getting involved with what you're doing with mortgage notes?
Well, before real estate, I grew up having a father that was a real estate broker, mostly working for developers of new construction in the South Florida area. And that was the 70s and 80s. And I had no interest in real estate. I just had to listen to my father talk about it all the time. A little did I know he was planting the seeds of what Malcolm Gladwell would later come to say was my 10,000 hours of experience in the industry. But I wanted to be a filmmaker, and I actually am a filmmaker. I shouldn't say that in the past tense because I always feel that there's another movie and another story in me someday. I went to NYU Film School in the 90s. I had a film production concentration. I produced several short films, won the 1999 NYU Film Festival with one of our thesis films. Which kind of propelled us, and we had already been propelled into Hollywood at that point because the film had kind of been done 18 months before that, and we had already gotten a movie at New Line. It starred some young actors at the time that we called names that you would know today: Jake Gyllenhaal, Jared Leto, John C. McGinley, Jeremy Piven, all folks that were early on in their careers. And we were I had this like budding film career, got into the Hollywood business aspect and had a cushy job on a studio lot, was living in LA and thought that I had it all figured out, but got very disillusioned with the business of Hollywood very quickly. And so by 2002, I was ready to leave LA, go back to New York, where I still had an apartment on the Lower East Side. But I stopped in Florida to see my parents, and my father, who still had a general real estate practice at that point, convinced me to stick around for what he said. Yeah, just stick around a few months and come work, in the business. And what do you got to lose? I also happened to meet my wife at that time. That was the fall of 2002. And real estate did really come naturally for me. Just stepping into it, having been in another business field, having grown up around it, it was just a natural fit. So I jumped right in and I told my dad, if I do this, I want to practice what you've always preached, which is not just that, is that real estate is the greatest investment and the real opportunity it has created the most self-made millionaires and billionaires of any profession out there. And so I started buying and fixing and flipping residential houses. I eventually got into some commercial development, and that led me into mortgage notes in the summer of 2008, right as the great financial crisis was getting started.
Wow. That's how was that time for you? I mean, were you scathed by that at all, or?
Well, yes. I don't think there is a investor in residential real estate that could say that they timed it all perfectly. And I don't think in any historical context, any of even the most successful guys in this field will tell you their woulda, shoulda, coulda stories, and we all, and if anything, my one scathing experience in 2008 was really the impetus and the motivation for why I got into buying mortgage notes and the paradigm that I created in managing those notes, post GFC. And to take that a step further, I got out pretty clean. I saw that the writing was on the wall. I was lucky enough to have mentors in the business who by 2005, 2006 said, there's a storm coming, get out now. And most of us were still scratching our heads, but I definitely felt something changing in residential real estate when the wholesale flippers were making more than the actual guys that were doing the work and selling the properties. When there was just you started to see a slowdown in pacing, a lot of which we are starting to see in certain markets today. But I got left with one property that was an investment property. It was, I had gotten my money out through a refinance and I was renting the property, but it was in an outskirts of South Florida in what they called a green and growing market. And in 2007, early 2008, when I had refinanced to put a tenant in this property, I had a $180,000 mortgage on it. And by about 18 months later, that house was worth less than $100,000. So you had seen such a dramatic drop in values and a reversal in values in certain markets that no one in real estate could really get away unscathed. I think there was something like 40% of mortgages that were underwater, from those early, and it could have been even more than that. I mean, when you think about the size of the residential real estate market, that means more volume of mortgages underwater, that is more than the entire commercial loan market that exists. So just to give you some perspective on what 2008 was. So yeah, I had that experience of an upside down mortgage. And then I had trying to deal with my mortgage company as someone who was a professional in the business, stuck in a situation, I was upside down and not wanting to ever miss a payment. I was calling my servicer and couldn't get anyone on the phone. I literally I had the experience that you may have heard of where servicers were actually telling investors and borrowers the only way they would be considered for a mitigation or a modification was if you intentionally stopped paying your mortgage. I mean, the things like that was what brought about the CFPB, actually. And so that's why that experience in and of itself really set me on my path to do what I do today.
Yeah, I remember when I went through, I just bought my first multifamily property in 2006, and I was lucky enough on the first few properties I bought to have longer term debt on it. So I was able to kind of wait it out and had renters in there and the cash flow. But I mean, the lucky thing about real estate back then versus, stocks is I can't check what it is. You know what I mean? It would have been a whole different story if you check in and you're like, oh, I just went down 75% from where I bought this a few months ago. So luckily, you don't see that. You see mortgage payment $1,500 and rent coming in $2,500, whatever it is, and you live another month. But yeah, that's very interesting how you're saying it, and it's crazy how that works. I never understood that. I remember calling in. We never had any issues with not paying mortgages during COVID, but I remember calling in and waiting on hold. And they're like, can you not pay? I'm like, we can pay fine, but like, what happens if we don't? And they're like, it was nothing. It was just. You know what I mean? And you're like, well, what happens if like there's an issue? Like, people stop paying rent. You know what I mean? Like, we don't know what's going to happen. And it was the same thing. You know what I mean? People were just like, well, if you stop paying, then you do this. And I'm like, that's the craziest thing I've ever heard in my life. You know what I mean? But
it was a wild west. They didn't know what to do. There was a bad advice being given. But that's when you see those kind of inefficiencies in a market, that's an opportunity. So when I bought my first, that was so what happened that got me into mortgage notes was I was out of resi fix and flip by 2006. I had been working in the commercial field, had bought a couple commercial projects, done some tenant rep work for restaurants and retail. I'm still a partner in that firm today. I have a very small group of brokers that work there in Southeast Florida. But it was the summer of 2008. and somehow I got a random phone call from a fund manager in SoCal. And he said he was looking at a pool of 2,000 construction to perm loans in Port St. Lucie, Florida, which was the north end of Southeast Florida, just north of Palm Beach County, the green and growing market at the time. And he said the bank, I think it was I don't know if it was National City, about to be bought by PNC, or it may have been one other bank before that. But they were like, the bank's going out of business. We can name our price. We just don't know what this real estate was worth. And these were all new construction loans. So the average loan was $300,000. And that was basically what it cost, $150 a foot to build a brand new 2,000 square foot house. And you had these brand new 2,000 square foot houses, many of which had never been lived in, first payment defaults. I mean, it was prime real estate. And we went to work that summer to figure out, what it was that things would finally sell at. The bottom was falling out in the market. We needed to know where the bottom was. And we found that about $100,000, about $50 to $60 a square foot, you would have cash buyers all day long. So we went out and paid $35 a foot to the bank or to the FDIC, whoever it was at the time. We started doing that. So we were all of a sudden in this really accretive position. We were paying 30 cents on the dollar. People were upside down, and a lot of people just wanted to walk away. So it was really developing a program around listening to borrowers' needs, knowing that the majority of the folks in this situation were not by no means of their own, and really working with people to create a way out. And that in the early days, that included a lot of modifications. So I'd buy a loan that was $300,000. Let's say I did have someone living in the home, and there was a $300,000 mortgage on a house that's now worth $200,000, which was a very common occurrence. I would pay, maybe $120 for that loan. So I could then go to that borrower and say, listen, you show me you are serious about keeping this. We're going to reset this. We say the property is now worth $200, even though it was worth $350 when you bought it and you owe us $300. We're going to reset the number to $195. We're going to put you in an equity position. All you got to do is make 6 months of payments at that $195 level, prove that you can make payments at that level. And then after 6 months, you get a permanent modification, a waiver of the 105 negative equity that I'm just giving it, just write it off. And at the time, the IRS was not charging debt cancellation, so it was a great thing. And that right there kept people in their homes. And we did that thousands and thousands of times across America. And I wrote a book about it called Win-Win Revolution. It was a huge win for us and my investors because we got to actually help people and keep a majority. We kept when I say a majority, I would say on average about 35 to 40% of the non-performing loans that we bought over the last 15 years have been modified, and we've kept the borrowers in the property or owning the property, which is a staggering statistic if you compare it to the industry, which would barely ever hit double digits, 9-10% modifications during that time. Nowadays, the modification is different because, post-COVID, anyone with a government guaranteed mortgage can basically call their servicer up, and there's a mandate amongst the GSEs to work with people. It's a different story today. But that's what we did. I wrote this book in 2017 about it called Win-Win Revolution. And since then, I've had a lot of my competitors kind of follow suit with teaching the guys in the private equity space, realizing that there's a better way to do it and that you can still make money, but, kind of follow your own guidelines that are even as good as the CFPB.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
So, Bill, can you give us a little bit about what your company does now, First Lien Capital, and kind of your whole overall investment strategy?
We are a private investment management firm. We take on two types of investors. We take on mostly a lot of limited partners. So anyone who is a qualified accredited investor can subscribe to one of our funds. We have one fund that is open for subscription now. It's closing to new investments at the end of this year. And that becomes our major vehicle to go buy these non-performing loans, both residential and commercial. And we buy it, what they say is that we were buying it on the secondary market. That's kind of an opaque term because, it's not like there's a corner store that you can go to. But it's the reference to the loosely connected group of companies, brokers, bankers, and investment funds that network to sell large swaths of debt or other assets. And so historically, post GFC in 2008, you saw a lot of banks that were required to sell. You had a lot of failures. You had a lot of sales through the FDIC, Fannie, Freddie. There was just tons of liquidation. There was a ton of product. So it was that. By 2016, the market had already turned. You had a lot of bigger money in the space, a lot of consolidation. And when I started First Lien, it was kind of seeing the writing on the wall, 2019, 2020, that maybe we had we were starting to come near another cycle. Now, what obviously happened in 2020 was COVID. And the magic of that was that there was a huge amount of government intervention, all this money printing. So I think it kind of kicked the can down the road a little bit. What my fund was set up to do was to really take advantage of whatever distress exists in the market. Like right now, last year, this fund was an approved investor, one of 24 in the nation approved to be a joint venture partner with the FDIC to bid the Signature Bank failure. The portfolio when Signature closed, down a few years ago, and then they auctioned all that off about a year ago today, to November of last year. We didn't win the pool. Maybe that's a blessing in disguise. But we're a partner with the FDIC. We've bought over 103 properties from HUD in the last 18 months. Some of these are vacant single-family homes out of the reverse mortgage program, where the borrowers have deceased, the heirs don't want the property, and we can pay like 60 cents on what's owed, and then we turn that into a fix and flips trade. We also do that in conjunction with a nonprofit of its own that we are actually helping, housing-based missions as well. So that's what we're doing, and so that's the main way that people get involved with us that are an accredited investor that likes the strategy. We'll take subscriptions of $500,000. We have family offices that invest a couple $1 million with us. We do some syndications and joint ventures with larger institutional funds, but anybody who invests in our fund is a partner in all of that, as am I. And so we've got a couple of sovereign wealths and a couple of national private equity groups that are lined up because the writing is on the wall, especially in commercial real estate right now. I think in the near term, you can expect to see, I know we probably have this podcast coming out early 2025. By then, I would be surprised if you didn't start to see some cracks in the structure and a couple of bank failures, or even maybe a private equity firm that starts to show stress.
So getting kind of digging more into note investing, we usually talk about equity investing on the show. So getting in more into debt investing, letting people know, can you let us know kind of broadly what definitions are of kind of when does a mortgage note become subperforming, non-performing? And, and what is your due diligence process when you're reviewing these notes to purchase?
It's a fantastic question. In the industry, generally, 90 days is the turning point for a non-performing loan. Assuming a loan that pays on a monthly basis, that would be a free missed payments. So it's in that first 30, after the 30, 60, 90 days of non-payment that the servicer is checking in with the borrower, trying to work out, trying to get them on the phone just to make sure. And actually, the reason for 90 days, historically, there's a stat actually that is the chance of a borrower catching up on any type of a loan payment dramatically decreases, by down to 10% or 15% if they've missed 3 payments or more. So that's kind of where the industry goes. And then what was the second part of that question? Was that?
Yeah, subperforming. What is that? They miss 1 or 2?
Yeah, subperforming is exactly that. It's in that first 90 days. And then you get borrowers, which we've seen a ton of subperforming. It still exists. And the industry is almost mandating that the subperforming market will continue because of the way the GSEs treat this issue. So in other words, this is probably, if I would have to say, the biggest wild card right now. There are a ton of subperforming loans that by all intents are considered fully performing. And I'm going to let you in on a little dirty, dark secret in two dirty, dark secrets about our industry. If you have a big enough audience, it could maybe change the world. One is, if on the residential side, if you have a government-backed mortgage, Fannie Mae, Freddie Mac, Ginnie Mae, that's a VA, an FHA, but most people, 70% of mortgages are government-backed, even if they're with a bank. So you may not even think that you've got a government-backed loan, but you probably do if you have a conventional mortgage. If you were to call your servicer up and tell them you have COVID today, they would say, okay, you don't have to make your payment. When would you like to make your next payment? And you could do that over and over and over again and basically kick the can down the road. Now, the reason, obviously, logically not to do this is you will have to pay that money back. It does accrue, but it just gets kicked back to the back. That's a program that still exists. That's kind of like under the radar, hush hush. Because if enough people really understood how easy it was to not pay your mortgage, you'd probably have a lot more people calling up. The second aspect of the dirty, dark secret about not subperforming debt in this country is in commercial. There is something called the Federal Reserve, the feds have changed the rules of the game quietly in the last few years. And there's two terms. One is TDR, troubled debt resolution, or troubled debt relief, I think that is what they call it. And then there's CECL, which is a reference to the way accounting for debt and stuff is done by the banks. It's a reporting. I'm not going to get into CECL, but basically the long story short of TDR and the concept of TDR is, if you owe me $100,000 or $1 million on a commercial property, your payment's $10,000 or $15,000 a month, and I call you up and say, I dropped in vacancy, I'm only got $5,000 a month of income, which is obviously way below my payment. The banks can rewrite that mortgage today to a $5,000 a month payment, even though that's now going to create a negative equity position. And as long as you make that payment, the banks don't have to consider it non-performing or even subperform. And that's gone on big time.
So that's like a negative amortization kind of programs.
They're not all. They try to avoid the neg am. So what they'll do is they'll reconstitute the back debt. They'll lower the interest rate down, to a number that's reasonable, or they'll split it into an A and B note, which is even more tricky. I've even seen the FDIC testing this as something they may have to do if there's a major crisis in commercial loans the next few years, where you would take the portion of the debt that the interest could cover with whatever the payment the borrower can make. Then you take the rest of the debt, put it into a B note at 0% that just sits in second position. So the bank can still call the whole thing accruing under this new terms, and that's what TDR allows. So you have, so even though you've only seen maybe a 1 or 2% increase in actual defaults through the bank reg data that's come out, the call reports, if you dig deeper and you add in the TDR, then we've probably seen a 3, 4, 5% increase in troubled debt just in the last year.
Yeah, no, that's definitely true, because when I work in mainly what we work here with multifamily properties, commercial multifamily, and when I talk to the operators, we haven't had any capital calls or anything like that, but when I talk to other operators that have had capital calls or issues, and if they've had good properties and they're performing, that they've gone back and it's workout. You know what I mean? They've had their workouts, and this sounds like a typical thing for them of how they can keep it clean on their books, how, they're just waiting out some market correction or something to happen where this borrower, I imagine, can sell this in the next 36 months or so. And everybody can come out, hopefully not losing any money. And I get that. I remember I had a contractor of mine that was behind on a mortgage back in like 2010 or something, or 2009. And the bank brought to him, they just said, this is what your mortgage is. We're going to give you a new mortgage right now. And obviously interest rates were lower than when he had originally got this in 2005 or 6. And it's 40 years. And you're like, okay. And you're like, I get that too. And I mean, that's a smart way of doing it to avoid foreclosure, I think. You know what I mean? Because you're just betting, we're betting, the person's not holding this for 40 years, let's be honest, right? Maybe 7 years is average, right? Up until, COVID, we saw that. People staying in their house are keeping a mortgage for 7 years. And so they're just like kicking the can down the road, being like, okay, the next 48 months, we're going to put our money on this person's going to sell this property to someone, right? And we're going to be out of this. And we didn't lose any money. And, it's a win-win. But I mean, it's a risky thing because you're with a sub-performing borrower kind of.
Yeah, and that worked for the last 15 years because interest rates were in a downward direction, right? It worked to kick the can down the road when money was cheap and interest rates were low. And you're right. Even today, that same program of conventional, when you go and say you have COVID on the resi side, you can have a conversation right there and then about switching to a 40-year mortgage. If you're upside down, you're just turning into a rent payment, but there is that slight possibility. It worked for GFC because the market reset, which by the way I believe needs to happen, the market reset, and people were allowed, some folks that I never thought would ever get out of it got into the money eventually, and I think that. But the problem is it's a much different world now. We're not going to. Prices are at an all-time high. We need prices to reset in order for the strengthening of the dollar, in order to allow Americans to live and survive, and in order for the economy to work again. That's just the nature of market cycles and the free market system. We want that to happen. And the reality is that interest rates are not going to start going down again anytime soon because the Fed knows it needs to break something in order to strengthen the dollar. And so it's a much different position nowadays. Those folks that are hanging on hoping for some sort of bailout, eventually the chickens, I think, will come home to roost. And we're just well positioned for all of that, to really be there as a capital provider and take advantage of what I believe will be the greatest buying opportunity of our lifetime. I have friends, I was a kid during the savings and loan crisis. And so I was maybe a teenager. I didn't know anything about real estate or business or anything like that. I remember my father talking about a condo crisis in Florida in the 80s. A lot of people don't even remember that, those newbies for Florida. But the guys that I know that are multi-millionaires in real estate today, some of them only did one deal during the S&L price. One deal. There was a 6-year period and I think that we'll end up there in some form or fashion. History doesn't repeat itself, but it always rhymes.
Yeah, that's for sure. Yeah, I remember my dad had been a multifamily investor since '84, and I remember him talking about a partner of his that bought a ton of units for like $6,000 or $8,000 a unit back in like the early '90s, and it was just like insane.
I mean, I was buying. If that was really insane, I would love to get to that point again. If that happens, we're probably post-nuclear disaster or something. But even in 2008, I was buying condos in West Palm Beach for $10,000, $15,000, $20,000 a piece, and those today are worth $300,000 all day long.
Yeah. I bought a commercial property in 2009 for $15,000 a door, something like that. You know what I mean? At that point. So it was crazy. I mean, I just had no idea that it would ever, I was like, oh, it's like, we'll never get back up to those levels again anytime soon. And, anyway, Bill, tell us about, just for like new note investors that are coming into this, you buy a property, you told us a little bit about how that conversation starts, but first of all, how do you do your due diligence on a note before you buy it? And then what happens once you have the note? How do I start that conversation with the borrower?
Yeah. And so there's, first of all, the due diligence is the most important thing. And what I've seen post GFC, you saw what I would call a tertiary market, right? Which is a secondary market to the secondary market, which is new investors. There's guys out trying to give books and lessons about how to become a note investor, how to use your 401k, et cetera. And that's all great. And that was for folks who, the most real estate investors are mom and pop. A lot of people do invest in one or two properties, commercial, residential. So it really kind of opened the market of note buying over the last 15 years to a broader audience. And a lot of people got burned because it's illegal. You're buying paper. So you have to know that your lien is perfected and that how to, if you have to enforce that lien through a legal or administrative foreclosure, that you have that ability. So the first and foremost, you got to know the law very well, and you have to have good attorneys. The most states, it's as simple as having possession of the original note solves everything. As you get a little bit higher up the food chain in this business, and you start to buy more and more of these notes, there's greater concerns like compliance, because when you start buying more than one or two notes in a state, you got to be either a licensed lender in some states, or you got to be in a DST, a statutory trust. And either way, I'm not a lawyer, but I like to play one on podcasts. I would never, it's not really our job. You're not legally supposed to, as an investor or anyone, go out and start collecting debt if you're not a debt collector. So in theory, you really leave the compliance, the servicing, the collection portion to a licensed servicer. And there are several that will take on individual investors. So if you want to get in the business, you find an attorney that you can trust to do the review of the collateral and the due diligence, which we're very good at. And the key is not just on the legal, but also knowing that you paid the right price. So that's a job you have to get good at, valuing what the real estate's really worth. And then figuring and buying notes that are non-performing, sub-performing, just like fix and flip real estate, it's kind of like a discount model. It's, I want to make X amount at the end. Here's how long I think it's going to take for me to fix the property up. And in this case, that means taking the property back through foreclosure or deed in lieu. And how long is it going to take me to get there? So what can I pay for the property? So you hiring a licensed third-party servicer. That said, you are the investor in the loan. You own the loan, and a lot of what makes the mortgage industry inefficient with regard to non-performing, sub-performing loans are those same servicers that are supposed to be keeping you in compliance. And this is really what the book kind of gets into, where, a servicer can only do so much smiling and dialing. They can send letters, they can try to get the borrower on the phone. By the time these loans come to us, those borrowers have usually stopped taking those phone calls. because they're embarrassed. They don't want to, what are they going to say? Oh, I owe you 40 grand. Sorry, I don't have it, So what we do and what we train investors to do or is to approach borrowers as the investor or have a real estate broker approach them not as a debt collection conversation, but how do we work together to resolve this situation? We don't even talk about numbers. We just say, here's your options. I see, you're having some trouble. I work with the lender. I'll have a broker call up someone or I'll have some of my staff go, hey, we're the investor. We on this loan. We know that you're in a tough situation. I see that foreclosure was filed a few months ago. How can we work with you? What would you like to do? And inside of that human conversation, you listen. If you listen well, you'll hear what their intention is. You'll get 10 or 20% that think that they deserve a free house, and they're just going to sit there until you drag them out by their tail. And, so you could try to be nice and offer, but okay, I'm putting that one on the list. Send it to the lawyers. Let's deal with it. But the majority of humans want to work something out. They don't want to deal with it. And I'll tell you, getting out from underneath something like this can be the greatest blessing to folks. So, if we can pay someone, instead of spending $5,000, $10,000 on legal fees, I say that to borrowers. I say, listen, it's going to cost another $5,000 for the attorneys to finish the foreclosure. You could live here for free for another, 3-4 months. It maybe saves you another $5,000. What if I paid you $10,000 today? I gave you the money to set you up in a new rental property. I'll even pay the deposit and just be out in 30 days. And then we won't even do a foreclosure. It won't be on your record. It's a win-win. And that's the method that we rinse and repeat over and over again.
Yeah, we call it cash for keys when in multifamily. So it works really well. I find the best time is when I don't mention a price and I ask them a number and they mention a number and it's usually less.
That's right. So true. It's funny. I got to remind my staff of this conversation, Charles, because a lot of my staff is based in New York City or the major cities where, they're used to, like, for them, it's like a $5,000 cash for keys is nothing, right? You go to like Wichita, Kansas, or Mississippi, if you $5,000 is like a half a year's salary to some people. So, yeah, you gotta really just. I need to teach my people to shut up and ask what the question first.
Yeah, it makes it easier because you're like, if you're out a little earlier than that, I'll give you additional money. But right. It's so anyway, it's a win-win for everyone, and it keeps everybody. They can leave. Everybody wipes their hands. Everything's a clean slate for both people, and we're on with our lives. So that's a great model of how it works. As we're wrapping up here, before you tell us more about your company, can you just if someone wants to get started in note investing, maybe on themselves, or if they're going to work through someone like yourselves, what would be some top tips? Let's say you'd give a new mortgage note investor.
There are a few resources there's good advisors in the world, and there's guys that are in it just for their own interests, and it's not easy to differentiate one from the other. So do some, don't start spending $10,000 a month or, join, and spend a ton of money on expensive education, because you can get a lot through books like mine and a couple of my other colleagues in the industry. You can learn a lot that way. You can attend a few lower price conferences to kind of get your feet wet and you got to start making some initial connections. There's a couple of good resources if people reach out to me directly that I can point them if they're very serious about it. The other recommendation, though, is, and this is kind of just my paradigm for life, which is, get on the court. I have seen so many folks over the years spend tens, maybe hundreds of thousands of dollars on education and events and podcasts and conferences and this and that. And, 3-4 years in, I say, oh, how's the business going? Tell me what it's about. And they haven't yet ever bought their first deal. So there is an aspect of it that you will learn the most by doing. And I learn something new every day. So there's a couple of websites out there that, you can get the myriad of information about our industry just by doing the research. And then there's some avenues to get your feet wet with lower value, one-off deals as well.
How can our listeners learn more about you and your business, Bill?
My company's website is firstlien.capital.com, spelled out FIRSTLIEN capital.com. My personal website is billbymel.com, BILLBYMEL.com. You can find me through either of those portals. By the time this podcast comes out, we will have closed our second fund to new investors, and maybe we will have opened a third. We'll see. But certainly, we're always open to new folks interested in our industry, and you can follow me on LinkedIn as well. I have my own podcast called The Real Estate Lowdown, which we got to get you on at some point, Charles.
That sounds great. Well, thank you so much for coming on today, Bill, and looking forward to connecting with you here in the near future.
My pleasure.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.